You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by Tradier, a REST-based open and secure API for investors, advisors, and traders. Open a Tradier brokerage account and trade the way you want with competitive pricing and a unique API. Learn more at Tradier.com. And now, let's get you into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means it is time once again for Options Boot Camp. Yes, you heard that right. Options Boot Camp. We've read your emails. We've seen your tweets and your various social media messages saying, where's Options Boot Camp? We love Options Boot Camp. Please bring back more Options Boot Camp. Well, we listened. We've been busy doing a lot of other things. I'm not sure if you checked out the network lately, but it's a lot of stuff popping off over there. But we always wanted to get you more boot camp, to get the band back together as it is, and really get the show back in your lives, because so many of you guys out there love it. We see it in the archives. You guys continue to attack it and download it and ask us questions. And so we wanted to really get it back here on the network for you guys, and it seems like that's going to be the case here going forward, starting off here and hopefully getting that ball rolling. Maybe playing with the format a little bit, too, to answer one of your other frequently asked questions, which is, can we get more Options Boot Camp in the sense of, can we have it in our lives more often than once or twice a month? And the answer, hopefully going forward, is going to be yes. What we're doing is we're planning to jazz things up a little bit, do the same old show you know and love, but make it into a little bit more easily digestible chunks for you guys out there so you can listen to it, enjoy it on the go. And hopefully the plan is you get a little taste of Options Boot Camp every week. How great would that be? So that's the plan. Hold our feet to the fire, hopefully. Hopefully we get to stick to that and all works out according to plan. And to help me do just that, he's got his whistle. He's got his black hat. I do believe he is ready to go. He is none other than Mr. Dan Passarelli, the author of a legion of options educational tomes, and indeed the founder of Market Taker, mentoring the man, the myth, the legend himself, the bearded one, Mr. Dan Passarelli. Dan, how's that for an intro? Welcome back to the show, sir.
Wow, like I'm ready for the mic drop here, man. So much street cred I'm getting.
You should probably just stop now because you can never live up to that intro, right? You just walk off. That's it. I'm good. Thanks for coming.
On top like Seinfeld.
Yes, exactly. Well, Dan, it has been a while since you and I have gathered here together on the old Options Boot Camp proving ground here. What's been cooking in your world? I know you had your big gathering. What's been going on in the land of MTM since the last time we chatted, sir?
Yeah, we had our annual options training retreat in Napa Valley, of course, because, well, I get to pick the location and, well, you know, Napa Valley. So, yeah, we had that. We're actually going to do our mastermind, which is a thing we started about a little over a year ago. For those of you who are listening live, which I don't think anybody's listening live, right? But
no, we're just you and I right now to get the band rolling, but we'll be live again soon.
Yeah. So, yeah, the mastermind kicks off tomorrow, and just got lots of fun stuff going on.
Speaking of fun stuff, what do you say we get to it, sir, with a little bit of the old basic training?
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
I miss that music, Dan. You know, it's just so jaunty. It feels like every episode is 4th of July, does it not?
Yeah, it sure does. I was actually thinking the same thing.
4th of July, maybe Flag Day, you know, pick your patriotic holiday, but definitely it's got a bit of a celebratory tone to it, which I like, which is appropriate. Because Options Bootcamp coming back in your life. Welcome to Basic Training. This is, of course, the segment where we break down sometimes some scary, sometimes some complex, sometimes indeed some introductory options, concepts, and techniques and strategies, and explain how you can use them in your own portfolios. And Dan, you know, we were thinking about what could we talk about here for the return of Options Bootcamp, and we thought, you know, it's been a while since we've addressed this topic on the show, and it certainly seems quite timely, because I'm not sure if you've been paying attention, Dan, but, you know, there's a little thing called the Fed, and they've been cutting rates of late, which a lot of people get excited about. But in the world of finance and world of portfolio management, that means your traditional low-hanging fruit sources of income are kind of getting a little bit harder to come by, getting squeezed a little bit out there. You can't just go and throw your money in a checking account and expect to get a nice yield, and you're doing your due diligence as a portfolio manager or as managing your own funds at home there. You need to go a little bit farther, work a little bit harder. Dan, would you say right now, what percentage of your students over there in MTM land are coming to you saying, hey, I need to get something going on this income front? Is that a big concern these days?
Yeah, that's really one of the main focuses that people come to us with is income. We actually rolled out, we might have talked about it on an old show, but maybe about a year and a half ago, we rolled out our income class for investors, just to meet demand, basically. You know, that's what a lot of people are asking us for.
It is indeed the hot thing. Everyone wants income. I don't care if you're your basic retail guy coming to options for the first time. You want to juice up your portfolio. You're a more experienced options trader. Maybe you're even out there managing someone's money, an RIA asset manager. Everyone's hunting for income out there. So we thought it was a good time to really break down some of the fun ways you can use options to do that. We'll start with the big dog, with the gold standard, the one that everyone kind of comes to the party for, and the way that, quite frankly, a lot of basic stock traders really get their feet wet when it comes to options, because they can usually wrap their head around it. Of course, you know what I'm going to say. It's the covered call. It's by far the most popular income trade out there. We see it used, you know, across a broad swath of different audiences. Everybody loves it, primarily because a lot of people come to the options world with long stock positions already in your portfolio. Everyone's got them. Could be a broad index-based ETP like a SPY, could be Apple, could be whatever the heck you have in your portfolio. Chances are you got some long underlying positions sitting there already. So now the next step of adding an income stream, perhaps your own dividend income stream, to this underlying is what we're going to talk about here. Very simple concept. Of course, remember, we hit on these in detail. If you want us to do a deep dive into the covered call, go back into the back archives of the show. We have done that. So I encourage you to go do that. Maybe check out Dan's income course while you're at it if you want to do nonstop deep dives into things like covered call. But quite frankly, listeners, you have an underlying position. Let's use XYZ, everyone's favorite stock. We've all made or lost millions in XYZ over the years. You own 100 shares of it. And now let's say you want to turn around. Let's say XYZ is trading 50. And you think, you know, I wouldn't mind selling this stock if it got to 55 in the next month. So you turn around and you sell the 55 strike call option. Of course, the call option gives someone else the right to buy that stock. You are selling them that right to buy it, a.k.a. you are guaranteeing to sell it at 55 anytime in the next month for this monthly option. And let's say, for the sake of our example, you are being paid $1 to do that. So now you've collected $1 for every one of these contracts that you're selling. Remember, of course, the multiplier. Don't forget that. So an equity option, the multiplier is 100. So that's $100 for every one lot you sell. If you have 100 shares, you're going to sell one contract against it. So that's going to be a one lot. You're going to collect $100 to do that. Now, of course, there's other things. There's commissions that eat into all of that. But effectively now what you've done is you've guaranteed over the course of the next month, if the stock XYZ rallies above 55, you are effectively going to sell it there. So you can see one of the inherent limitations of this strategy, which is effectively you're clipping your upside. So if you expect XYZ to shoot to the moon in the next month or whatever the time frame is you're writing this call, 3 months, 6 months, a year, I don't encourage you to go out that far, but some folks like to do that. Then make sure you do your due diligence ahead of time and determine where you like to sell that stock so you're comfortable with that. And that's the first step there. But it's a very basic position. You can see why people like it. And now, of course, let's say in this scenario, XYZ slowly drifts up to 53 over the course of the 1 month of this option. The option goes away. It's worthless now at the end of September expiration. You keep that $1 you sold. You also keep $3 worth of appreciation in the stock. Not a bad little trade. And guess what? You get to do it all again the next month if you want. So you go out another month, and let's say this time stock's 53. Maybe you want to sell 60 calls, something along those lines. Let's say for sake of our arguments, these are very rich volatility environments. You get another $1 for that. You can see how that would be attractive if people rinse and repeat, particularly if you're already using levels at which you're comfortable selling the stock to begin with. So that's a very basic overview, a little primer there on covered calls. But Dan, you're out there teaching the class on these things. Sounds like people are really devouring it over there. They love their income. They love their covered calls. So walk us through your approach to covered calls. What are some of the interesting nuggets, maybe rules of thumb, points to remember you like to walk people through when they're doing these? Because obviously at the end of the day, covered call, it's a big one. A lot of people like to use it, sir. So what are your go-tos when you're out there mentoring people on covered calls?
Yeah, we've actually invested a whole lot of time and resources on really just analyzing the heck out of really what makes them tick. And we've got some interesting takeaways to share. The one is that covered calls, there's been all these studies out there that say covered calls outperform simply owning stock in the long run. And the thing about that is that that's true when covered calls are used as part of a long-term system where you constantly have on a short call, or sometimes we do what I call the recycle trade, which is alternating covered calls and cash secured puts. But, like some people make the mistake of just putting on one covered call one time, and, they eke out an extra $85 on their 100 shares, and they rightfully so say, wow, this is really no big deal. Why am I wasting my time with this? And when you just make one covered call trade, that's actually true. But when it's part of a system, it becomes really, really powerful, and that's why it outperforms.
So have the system. That's your main advice for people. Have a system. That is good advice because there is a lot more involved and baked into the covered call trade than just selling the call. Obviously, there's a lot to think about there. Obviously, you talked about strike selection. That's kind of number one, really. That's how the game starts. You have to sit there and really think about what is your outlook for the underlying. And therefore, are you comfortable? Do you want to play with the fire a little bit? You want to get a little bit closer at the money, get a little bit more yield? You're obviously potentially giving up more upside as a result. So there's no free lunch in the options market. You want to go a little bit farther out, give yourself a little bit more room to run on the upside. Well, if that upside doesn't happen, you're not really collecting a lot. And that's where Dan's referring to with some of these covered calls. Don't really get you that excited because you're not really getting a lot of income for them. Or do you want to go crazy? You want to go hardcore in the money? Sell deep calls. That's a conversation we'll probably have again on even another episode here because that's a very specific approach. Also, remember your tax situation, whether it's you, whether you're managing money, whatever the case may be. Can you sell the stock at a particular strike, or will that cause some sort of tax implications for your portfolio that maybe you don't want to deal with? Maybe you don't want to incur capital gains just to sell this, 10 lot of calls and get a little bit of income here or there. So maybe that factors in. And of course, and Dan, do you have, that's a big question a lot of people have. You and I coming to this from from old school options traders. We think you sell a covered call, the stock rallies to your strike, stock gets called away, woohoo, you win, let's do it again. A lot of people come to it though in the investing world and they see the tax side of that and they get scared and they don't want that. So what do you counsel people about maybe when to roll versus when to just let the stock get called away and close it out?
Yeah, that's a great question that we spend a lot of time with within our system. Your objective, like one of the biggest causes of failure of covered call traders is not having a congruent objective with, what they want to have happen from the get-go, and then planning a trade around that objective. There's basically, we've come up with 8 criteria that are essential for every covered call trade. We call it our 8 nail the trade criteria. And actually, why don't I just kind of offer that up to our listeners? If you want to check that out, you can simply go to markettaker.com/nail-it. So market, like stock market, taker, like take something, /nail-it, all one word. And you can get a little printout of the 8 nail the trade criteria.
Look at you with the freebies. I like it. I'm pulling that up as we speak. I want to nail it too, Dan. So I want to check out your nail it here. Market taker. Remember 2 T's there, listeners. Don't forget the T in the middle. Add on the extra T for trading. All right. But yeah, check that out. That might be a good little handout, a little pamphlet, a little worksheet to have in your back pocket there. Another thing you might want to think about if you're scared about stock getting called away, of course, or perhaps maybe not worried about roll. Maybe you're not super firm in your underlying outlook. You think maybe there's a chance it might pop, then maybe a call vertical is the way you want to go instead of just writing the call. Or, of course, you can not write the call altogether if you're that worried about it. But a call vertical, that means obviously you sell, let's say in for the earlier example, you sold the 55 call, and then you're worried that a stock, if it keeps running, if it breaks by 58, 59, is going to take off. So maybe you buy the 60 call against it. So maybe now instead of selling that one call for $1, you buy another one for 25 cents against it. So now you're only collecting 75 cents. So obviously your income stream is a little bit diluted there, which that's the downside of it. But of course, if the stock takes off again, you will participate in that upside again beyond the 60 strike. So that's one way you can maybe mitigate some of those concerns. Now it's going to dilute your income stream, but as long as you're okay with that, then that's an interesting one to consider. We can probably do a whole episode on just covered calls, and indeed we have, so I encourage you to check out those in our feed here. But in general, I wanted to go through those. There's also the debate about in-the-money versus out-of-the-money covered calls and how to approach them. I might want to save that for another episode because I do believe we will be talking about that in the near. But that is also a consideration and one that doesn't get a lot of love. But really quickly, Dan, are you a fan of in-the-money covered calls or not so much?
For a very specific objective, yes. As a matter of fact, I was just telling the story in a presentation on covered calls last week in Scottsdale. There's a guy that I know. His name's Paul. I refer to him as one of the top 3 smartest people I know. Was a big trader for Bank of America. And he retired early, and one day I was talking to him, and I said, "Oh, so Paul, what are you doing these days?" He goes, "Oh, well, I'm just managing our family's money." I go, "Oh, how you doing?" He goes, "Oh, well, covered calls." I go, "Oh, what's your technique?" And he says, "What I do is I just go through our portfolio. I find the weakest stocks that I would like to sell, and I sell an in-the-money covered call." Yeah, and at first when he said that, I thought, well, that's kind of weird. And then I thought about it, and it's freaking brilliant. It's basically a way to sell, say like $100 stock at $103, So when you have that objective, that can be so powerful, and it's really underused.
It definitely is, and that's not the first story I've heard of similar, and people I've encountered here in Chicago and others who are experienced hands, old SIBO hands, who do love that in-the-money covered call approach. So there certainly is an audience and a use case for it. I think we'll get to that more on a future episode. But we've got to touch on some of these other hot income methodologies. Remember, you might have to go a little bit farther afield these days. Rates are coming in, income a little harder to find. You can't just go blast away your typical proverbial 5% out of the money covered call and expect that's going to do all of your income needs for you. You might have to go a little bit farther afield, get a little bit more aggressive, get a little bit more exotic. Another one to do, and remember now, people get scared when I say the next one. But of course, from a risk perspective, if you're okay with covered calls, you should be okay with doing our next one, which is indeed the short put. And I say, oh, naked short put, people get super scared, or cash secured short put, however you want to look at it. They get super scared. Oh, that's super risky. I would never do that. I'll stick with my covered calls. Of course, synthetically, from a risk perspective, covered call, short put, the same thing. If you don't understand that, again, check out our archives or call up Dan and his team over there. They'll walk you through it. So effectively, if you're scared by this one but not the other one, you might want to rethink your options approach there. Now, this is not typically used, until we get to our next versions, not typically used in conjunction with a long underline. That's why I held off on it a little bit. This is usually used to initiate a long underlying position. So if you're coming to this, you're fairly new to options, and you're saying to yourself, I'm used to buying stock with a limit order and selling stock with a limit order. Well, then guess what? We've just covered 2 ways now for you to get paid to do those same exact things in the underlying. The short put, of course, you are selling to someone else the right to sell a stock at a particular price at any time during the course of that option's lifespan. It sounds a little counterintuitive, I know, but by doing that, you are effectively guaranteeing to buy the stock at that price. So in our other example, XYZ was at 50. Now we're going to go to the downside, to the dark side. You could say, hey, I'm going to sell that 45 strike put, $5 out of the money. That means you're guaranteeing to someone else at any time during that 1 month of that option's life, you will buy that stock at 45. So that you could see what the inherent risk of that position is. If XYZ falls off a cliff down to 20 or 10, you're holding the bag from 45 all the way down and beyond. So it's the same thing as if you worked a limit order in the stock to buy it at 45. But in our scenario, now you may, let's say, same thing as a covered call, say you get paid $1 for that. So now you've collected $100 for every 1 lot. So there's a little bit of an income stream there. You can see why it's preferable over just doing the stock order by itself. Now, there are some scenarios where people prefer the stock. That's when the stock really gaps down, because in those scenarios, you're going to be holding the bag on the put side versus the stock. Hopefully, and it doesn't always work out this way, but hopefully, if there's a gap in the stock, it'll hopefully gap through your order and you'll get filled where it opens again somewhere much lower. That's the idea. It doesn't usually work out that way. Usually you get filled on the upside and everyone's upset. But that's the one little bit of caveat people put out there on selling short puts is, of course, the gap risk. So if you like to get long, you want to get long some stock in your portfolio, maybe you already have some stock and maybe you want to buy some more. And you've identified a price that you want to do that in. The short put can be your friend. Remember though, people see this short put, they see, oh, I'm collecting this $100 for every 1 lot. This is money that's in my account. That's just free money. I'm just picking up all this money. Remember, there is an opportunity cost to this trade. Brokers are not just going to say, okay, you've got all this downside risk, you can just let that sit there for free. No, they're going to tie up some of your capital to hold in reserve as margin in case you have to buy that stock. So all of a sudden, if you sell a put, you're going to see a bunch of your trading capital is all of a sudden not available to you to do other trades because it's being held in reserve in case you have to buy that stock. So if you're all of a sudden selling puts and saying, wow, where did all my trading capital go? Even though you didn't use it, you didn't use it in this trade. Technically, it is needed in case the trade goes against you. So there is an opportunity cost. It's not just picking up nickels and dimes and dollars here or there. There is a bit of a tie-up opportunity cost to this trade. And of course, if you're concerned about downside risk continuing, the same thing as with the covered call. If you're concerned about downside in a stock, you can always sell the put spread. Let's say you said 45 strike put. Now against it, you buy, let's say, the 40 strike put. So now you're really only at risk for that $5. And beyond that, you're not going to participate anymore in the downside. You will have effectively stopped yourself out. So in case there is a catastrophic event, you will be insulated. Of course, the downside to that, pun intended, is that you're not getting all the income you perhaps were hoping for from this strategy, but there is a little bit of risk protection there. Dan, short puts, you know them, you love them, talked about them before. What's your go-to MO for short puts versus put spreads? How do you usually counsel people when they're approaching this technique?
Yeah, I mean, I think when people are afraid of it, I find that with anything, as long as, if you just keep asking questions like, why do you think that? Well, why do you think that? I mean, what it gets down to is people are afraid that, well, I might get assigned and I might have to buy the stock. Like, well, do you own any stock now? Well, yeah. How'd you get it? Well, I bought it. So this goes back to the exact same thing. The absolute most key thing that we teach is set your objective before getting into the trade and set a real objective. Like one of the problems, like here's one of the reasons why people do kind of have that sort of almost strange take is because they'll be looking at a $120 stock and they'll say, oh yeah, if this ever gets down to 115, I'd be happy buying shares. And then it gets down to 110 and they go, oh my God, this is terrible. But if they approach it from the beginning and actually do want to buy it, then just like you said, hey man, it's no different than working a limit order and you'll be happy when you get assigned instead of upset.
Exactly. And that's the mindset really to have with this, is that you approach it like you're using it, limit orders in the stock, and you'll be a happy camper as long as you do your due diligence. If you just start writing the puts to get that income and all, you don't really want the stock down there, and all you're just maybe getting a little more aggressive than you should have. That's where people obviously get into trouble. Now, speaking of getting into trouble, we're going to get into some of the more interesting, more esoteric strategies now here. Starting off with one that actually combines the two, and a lot of people like this strategy. Dan, I'm not sure if you're a big user of this or not. It's kind of called the wheel. And what it does is it allows you to have an income trade effectively on both legs of your underlying, getting in and getting out. Now, I just said that. What does that make you think of? The two strategies we just talked about, right? Well, let's say we put those together. Let's take our old friend, the short put, and the covered call, and let's put them together. Now you have what is known as the wheel trade. Our friends over there in St. Charles Wealth Advisors and RCM and others love this strategy. It's one of their go-tos. What it involves is effectively what we just talked about. The short put, this time using it with an eye towards potentially opening up a long equity position. So, and again, XYZ selling the 45 put, Trox trading at 50. Over the course of that month, let's say it drops to 44. Now, you've bought that stock at 45, but you collected $1 for that option, so you're pretty much at break even. And now you have this stock position. What do you do with it? Well, maybe you want to turn around, get income, and get out of it. And so you sell another covered call. This time, maybe you sell the 45 covered call this time for $1. And the stock rallies up. It goes up to 45. Your stock goes away. You collect $1 for that. So now you've made some money on that trade after all, using a little bit of an income stream. That's called the wheel because you're selling a put. Your put gets assigned to you. It wheels in, and you kind of just wheel it out. It's just a rotating wheel. You can do it over and over and over again. And hopefully, if it works out, if you're not left kind of holding the bag on the underlying a little bit, then it could actually be a decent little income stream for you. And there's only certain names that really are suitable for this, so do a little bit of your homework ahead of time. But the wheel is a fun one a lot of people like. And again, it's very simple. We're not trying to scare you here with super crazy exotic techniques. Anyone could do the wheel. If you understand a covered call and you understand a short put, you can do this. And this is another scenario where that in-the-money covered call might make some sense because you don't really maybe want to hold on to this underlying too long. You're kind of just doing it as an income trade. So an in-the-money covered call may be an appropriate way, particularly maybe if something happens in the underlying and all of a sudden your outlook has changed and you want to kind of just get rid of it. In-the-money covered call may be a use case here for that. The other one that gets people kind of scared, Dan, you don't see it too often. In fact, I was surprised to see our friends over at OIC, the Options Industry Council, actually do a study on this not too long ago, which was surprising to me because it scares people. And that's, I guess you can call it a bunch of different things. Maybe covered strangle, covered combo. A lot of people call it the latter. This is effectively, you have a long stock position, and then you sell a covered call, out of the money covered call, usually against it. You understand that portion. That's pretty straightforward covered call. But now you want more income. And that's where it gets into this environment where finding income's a little bit harder. Maybe if you go a little bit farther afield. You're adding another short leg now to this trade. And that's where some people get a little spooked. You're adding the short put now to this position. Now you're saying, wait a minute, I already have the stock. Exactly. That's where people get a little spooked because let's say in this scenario, XYZ trading 50 again, you sell the 55 covered call for $1. So stock rallies 55, you're out and you keep that buck. Down the downside, you sell that 45 put also for $1. Now you're saying, okay, if the stock drops to 45, I'm okay in this scenario buying more of the stock, adding to my position at that level. So if you're looking at an underlying position, you say to yourself, you know, I wouldn't mind picking up some more if it drops to this level. Then this scenario may be a good one. This strategy may be a good one, a useful one for you. It does add a second income leg, but it has all the other caveats we mentioned before. You're short a call and you're short a put. So you have two short legs now effectively in that trade. So if that's a little overwhelming for you, maybe not the strategy for you, but there has been some interesting research on it. I encourage you to go to optionseducation.org, check out their study on the covered combo. You can see how in terms of Sharpe ratio and Sortino, all those ratios, and indeed in terms of total return, it's actually up there and actually outperforms a lot of the underlying indices themselves, which may be counterintuitive. Some people think it's super risky. It actually does fairly well from a risk-adjusted basis as well. Dan, it's not a strategy we talk about a lot, but again, these are challenging times from an income perspective. So is this one of your use cases? You ever have your students approach this, the covered combo? And also, what do you think about the wheel trade, sir?
Yeah, absolutely. I love them both. The covered, so I love them both as an investor, okay? Like any conversation about covered calls or cash secured puts, the wheel, the covered combo, I love them all as an investor, as part of your long-term investing plan. If you already own the stock or if you want to own the stock. I'm not a big fan of doing it as a trader, like doing the wheel and, look, I bought this stock. That's okay. I'll sell an at the money or in the money covered call to try and get out of it. Like, I feel like if you don't want to own the stock, I feel like if you don't want to own the stock, then there are other strategies that you probably ought to be doing instead. Make sense?
That does. I know you like your delineation between trader and investor. And, of course, if you want more on those delineations and what each should do, Dan's the guy you should hit up over there. And let's wrap it up with this one. I kind of saved it for last. It's very popular. It's not a traditional income trade, and that it usually doesn't generate income, but it has an income component. That's the collar. That's another one people might be considering in this environment because income is hard to come by, but also the markets right now, fairly top-heavy. There are certainly a lot of people out there who have a little bit of concern about these valuation levels. So you may be actually looking for a little bit of protection. And that's where the collar comes in. It combines, of course, our old friend, the covered call on the upside. So usually selling out of the money covered calls, a way to generate some income stream against a stock you already own. And now also you're worried about downside, so you're buying a put. And that's where I say there's not really net income on this. Usually you're paying for this, unless you do it very well. And some people like to work and construct zero-cost collars. Not a huge fan of those because it usually means you're buying some farther out of the money put than you wanted and you're selling some nearer to the at the money call than you wanted and make it all line up. I'd rather have people do their homework and choose their strikes independently rather than trying to make them line up from a premium perspective. The way I like to do collars, and I'm sure Dan has a take on this as well, is, push the put out a little bit somewhere in the 3 to 6 month range. So you're not just paying for decay every month. And then you write your call in the nearer portion, probably in the monthly range. So hopefully if you construct it well, over time, in the initial outset, you're going to be paying for that put. But over time, if you write the calls, it should hopefully pay for a good chunk, perhaps even all of that put over time. That's the goal anyway. So 6 months seems to be a decent time frame, 3 to 6 months. Beyond that, you're paying for a lot of time decay and a lot of time premium, really, that you maybe don't need. But that's an individual choice. But that's a decent way to construct it. And so the collar, if done well, can turn into an income trade at the end of the day. But you also are getting that protective component, which people like. Dan, I know you're a fan of collars. How do you like to set them up? How do you like to counsel people when they come into you saying, I want some protection, but I don't want to pay for all of it?
Yeah, there's two ways to do it. The one is just a super straightforward way where you just buy the put, sell the call to pay for it, and let it sit. But I like the way that you were describing, which we call the split time collar. Excuse me. We call that the split time collar, where you buy that longer term put and then sell the shorter term ones. But, that's a little bit more active. That's not for the faint of heart because with the traditional collar, you just put it on and you go on vacation for 6 months. It doesn't matter. You don't even have to look at it. Whatever happens, happens. But with the split time collar, there's more management, and you've got to, you probably don't want to get assigned because, well, if you wanted to get assigned, you would just sell the darn stock in this particular case. So, yeah, I love them both. Really, really useful.
We love them both as well, Mr. Passarelli. But unfortunately, that music means we got to get out of here for this first return episode. Trying to do a little bit more bite-sized episode. This is still a pretty meaty one here, listeners, but we're trying to get you a good amount of meat on the bone. Then we get out of there. You guys can get more episodes in your ear holes that way, and it makes it easier for us to produce them a little bit, too, so everyone wins on that front. So hopefully you enjoy this. Let's do a quick recap here. Income strategies for these low rates environments, the gold standard, the covered call. Remember, set your rules at the outset. Can you sell the stock? Are you comfortable selling it there? If not, when are you going to roll? Those sorts of things need to be established at the outset before you actually do the trade. It's too late when the stock's exploding up to your strike. What do I do now? Because the horse has already left the barn. It's too late. So establish those rules ahead of time. Do your diligence on your strikes. and you'll be a happy camper. May have to get a little more aggressive these days to get the income stream you want. As long as you're okay clipping your upside, that's one way to do it. Short put, if you like covered calls, short puts can be your friend. Just use them well. Establish your levels. Be comfortable buying the stock there, and you'll be good. If you're very worried, short put spreads versus puts. The wheel, combo of the two. Some people like this one. You get it, you get in, get out, move on to the next one. It's same underlying, maybe different ones. It depends on your viewpoint. Maybe you want to just use it as a way to get into the stock, and you really don't have any intention of selling the stock. You're just selling calls against it, and if you get up there, you roll it. Either way, the wheel could be an attractive one for you. Covered combo, getting a little bit more to the dark side here. 2 short legs against that long stock position. Short covered call and a short out of the money put. So if it drops, you'll be buying more of that stock, as long as you're okay with that. But the income stream, you're getting a much healthier income stream. Remember, the put's usually far more juicy from a volatility perspective than the calls. So that's a way to really juice up your income. And in this environment, that may be one you want to consider, as long as you're okay with the levels you've outlined. And, of course, our old friend, the caller, getting that protection and also hopefully not paying as much if it's done right, maybe not anything for that protection at the end of the day, which is kind of the gold standard for protection. And, Dan, if they like all this, they're intrigued by income, they want to learn more, maybe they want to check out that little handout you mentioned. Where should they go? What should they do, sir?
Yeah, that's a great place to start. If you're interested in learning about covered calls, cash secured puts, or if you've been doing it a while and want to get a little better at it, just go to markettaker.com/nailit. It's just sort of my contribution to you to help you learn to trade better and get better with your covered calls. markettaker.com/nailit.
There you go, listeners. markettaker.com/nailit. That's his contribution to you. And, of course, this show is our contribution to you and your continued successful trading. Good luck to you out there, and we'll see you back here next time for more Options Bootcamp.
Options Bootcamp is brought to you by Tradier, a REST-based open and secure API for investors, advisors, and traders. Open a Tradier brokerage account and trade the way you want with competitive pricing and a unique API. Learn more at Tradier.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available on the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.